Thank you, everybody, for tuning in. Looking forward to chatting with you about our outlook for the market for the remainder of this year, taking into consideration what happened last week, which I think could have been a surprise to many people. But as we ended July, which was a very strong month, but in some ways not surprising because July is the fourth best month of the year on average. Some people worried that we had gone too far too fast. And so what I'm going to do is discuss what are the items in this wall of worry, reviewing several of the things that were of concerns to investors. I'm then going to talk about why I still think that this bull market remains in force. And this session goes on until 11:10, so I'm making sure that I do leave some time for audience questions. So if you do have them, please put them in the question box so that Charlotte can then ask them of me after I've finished with my formal presentation. But when I say that the market went too far too fast for some people, well, what was the reason for that? Well, actually, the market gained 28% from the April 8th low, in which the S&P had declined nearly 19% from the all-time high that had been set on February 19th. All sizes, styles, and sectors were in positive territory during that period. 94% of the sub-industries had also advanced from April 8th through the recent high on July 28th. What we also found was that through the 27th of June, we actually recovered everything we lost in the February through early April decline. So pretty nice returns, whether you look at it from the market bottom on April 8th, the fact that we recovered everything we lost in only 2 months, whereas normally it takes about 4 months to get back to break even from a decline of up to 20%, yet we did so very quickly. Yet along the way, we had earnings growth collapse. At the end of 2024, estimates were for about a 13% gain in S&P 500 earnings. However, at the end of June, that estimate had fallen to 6.8%. So earnings growth was nearly cut in half. Well, what's that old saying? Prices tend to lead fundamentals. So when we did decline by 19%, certainly not a surprise that the earnings forecasts experienced revisions to the downside. We also ended up at the all-time high in February with a PE on forward S&P 500 earnings that was more than 2 standard deviations above its 20-year mean. So that certainly was a cause for concern. In addition, we had a level of over-optimism as seen in the CNN Fear Greed Index, which had posted an extreme greed reading. A lot of investors do like to look at that as a contrary indicator. We also had tariff turmoil. What were the adverse inflation and earnings impacts from tariffs? How come we have not seen them yet? Are they delayed? Because they certainly cannot be eliminated. So that is a concern that investors have regarding this recent advance. Also, seasonality. We are approaching the most challenging period, or actually we just started the most challenging period for equities. August and September are 2 of the 3 months of the year, add February to that list, in which we have seen the market post an average decline in those months. September is even worse because not only did it post an average decline, but it fell more frequently than it rose. Also, October, while the return is positive, the volatility is 1/3 more than the average for the other 11 months of the year. So I guess Halloween is in a good month because investors do get spooked by the volatility that they have typically seen in October. So now the question is, let's take a look at valuations. Here is a forward PE ratio of the S&P 500 going back to December of 2004, according to S&P Capital IQ consensus estimates. So NTM, or next 12-month PE ratio, and the middle line around 17 is the long-term average. So we had peaked ourselves above that 2 standard deviation level. Now, some would push back on the 20-year mean and say maybe we really should be looking more at the 10-year mean. If that's the case, then we are slightly above 1 standard deviation from the mean. Yet, if you have not technical, but analysts who cover the information technology space, because of AI really only entering into the marketplace in the last 5 years, some would say you really should be looking at 5-year means. And in that case, we are within 1 standard deviation and therefore within a more normal PE environment. So I share this with you to be able to examine all different possibilities. Here you can see on the left-hand side the 11 sectors in the S&P 500, the benchmark itself, the mid and small cap indices. What was the second quarter earnings year over year estimate as of December 31st, March 31st, June 30th? The middle grouping is for full year 2025, and the far right-hand grouping is for full year 2026. Now, looking at the middle grouping 2025, you can see how 12.8% was the estimate as of the end of 2024, whittled down to 9%, and then sub 7% as of June 30th. Shift a little bit to the left, we see what the Q2 earnings estimate was, 9.2 as of the start of the year, 6.8 through the end of March, and then on June 30th, we had only 2.2, with 7 of the 11 sectors expected to post earnings declines on a year-over-year basis. So certainly you had enough reasons for investors to be worried. And with us entering into a fairly challenging period, as I just mentioned, normally July was up 1.2%, fourth best month of the year. Frequency of advance, sort of like a batting average, pretty similar to the average for all months, up 59% of the time. Its highest 1 month reading going back to World War II was 9.1%, pretty much in the middle. The deepest decline at 7.9%, well below the average for all months being 11.3%. Standard deviation or measure of volatility, a little bit below the average for all months, and then its ranking is 7 out of 12 months of the year. Yet when we go into August and September, you can see that we do post average declines. As I mentioned about September, only 44% of the Septembers going back to World War II posted increases. Not a very impressive highest gain, only 8.8% going back in time. The deepest decline of almost 12% was greater than the long-term average, but if you look to the right-hand side, nowhere near the worst showing for October, which was down nearly 22%. That was back in 1987. Volatility a little bit higher than average for both August and September. And as I mentioned before, 18.5, the highest monthly standard deviation in October, which is about 1/3 greater than the average for all 11 months of the year. Also, an interesting stat is if you go back in time, what you find is that August tends to be lower during the first year of a president's second term in office. So I highlighted in orange Eisenhower, also Nixon, Reagan, Clinton, Bush, 43, Obama, their second years. How did the market perform? On average, down 3.4% and negative 100% of the time. What we also find is a similar situation for the NASDAQ, down 100% of the time, and for the Russell 2000, down all but one time. So there is a lot of pressure in general that is typically found in August. And that is not necessarily a surprise, just something that I think investors should be aware of. I'm a big believer in not allowing your emotions to be your portfolio's worst enemy. So, a lot of the work that I do talks about being aware of bumpy periods in the market. My thought is that if you are aware of these bumpy periods, you will not be surprised by them and then do something that could adversely affect the long-term return on your portfolio. So just be aware that there's a very high probability that we could see a negative August, but it doesn't mean that the bull market has come to an end. Certainly, when we think about what happened in the full prior week, it almost feels as if investors were expecting that the bull market probably was topping out. If you look on the left-hand side, you'll see different asset classes. You'll see large, mid, small cap indices, as well as the 11 sectors in the S&P 1500, which includes the large cap 500, mid cap 400, and small cap 600 companies. You can see that every one of those sectors posted declines for that week. Large cap, mid cap, small cap fell on the week. So did emerging and developed international. The only thing that was really up was utilities in a flight to safety, up 1.4%. Oil prices were higher and bond prices were higher. As you can see toward the bottom, the yield on the 10-year note declined. So, like a seesaw, when the yields go down, the prices go up. On the upper right-hand side, you can see these were the 10 best performing sub-industries, and there are 155 sub-industries in the S&P 1500. A lot of them were in the more defensive areas of utilities, healthcare, consumer staples, etc. And as you can see, the gains were really only 6.6% or less, whereas the declines in the bottom right, in a sense, go anywhere from 10% to 24%. So a beating that a lot of investors took. Well, our feeling is that we're not really looking for anything more than a potential pullback if we should end up with a more meaningful decline in the next couple of months. I like to say that declines of anywhere from 1 to 4.9% is noise. And obviously, the closer you get to that minus 5% threshold, the louder the noise. Once you go beyond 5%, I call that a pullback. 5 to 10% declines. We've had 63 of them since World War II. When you look at corrections, which are 10 to 19.9%, we have had 25 of those since World War II. So sure, we've had an awful lot of declines of anywhere from 5 to 20%. On average, we have them at least once a year. So nothing really to be too surprised about. Also, when I sort of look below the surface, this is a chart that monitors what percent of the 155 sub-industries in the S&P 500 are trading above both their 10-week and 40-week moving averages, or in other words, their 50-day and 200-day moving averages. The dashed red line on the top says, you know what, we're getting a little bit overbought, a little too optimistic. Too many of the groups are well above these readings. However, the black dotted line around 10% says, uh-oh, time to be a little bit cautious. And then if we're at the 5% threshold, then it usually is an indication that we've been oversold. Well, on April 8th itself, we had gotten down to only 1%. There were only two industries that were in positive territory, healthcare distributors and water utilities. So that sort of indicated to me that investors had thrown the baby out with the bathwater. So that was an indication to us. And I wrote my weekly Sector Watch piece on April 14th, bottoming bearishness. So I thought that the decline pretty much had run its course. Of course, I got some assistance from our Lowry Research, our technical analysis arm, because they look to thrust indicators, as well as other shorter term indicators to help to make more accurate changes in our overall direction of the market. What I show with the arrow on the right-hand side is where we are today. So we are a little bit below the long-term average, but we have bounced from where we were last Friday. So in a sense, we're still well in the middle of the pack, not indicating that we are oversold, overbought, and from a trend line perspective, indicating that we're probably continuing to work our way higher. But what was it overall that really spooked the market? Well, I think certainly it was the worries over tariffs, the continuing turmoil because we have not come to terms with China, not come to terms with Canada, also questions about India, et cetera. And so an awful lot of uncertainty remains out there, and whether we are likely to see an impact on GDP and on inflation. And then on Friday, we ended up with the employment report that indicated that possibly the economy is slowing more than anticipated. And the worry was that maybe we're even headed for a recession. So what is it that worries investors? Well, I like to say that bull markets don't die of old age, they die from fright. And what they're most afraid of is recession. So this table shows all of the recessions going back to World War II. This you can find on the National Bureau of Economic Research's website, because they're the ones that tell us that we're either in an economic expansion or contraction, and contraction is the same as recession. So the next column shows how long these recessions have lasted, by how much GDP decline. And in 1980, the NBER's Business Cycle Dating Committee started letting us know when they think we went into recession. Unfortunately, their timing is not great because they tend to let us know, on average, about 7 months into a recession that the speed bump we hit a while ago was the beginning of a recession. So not very good from a timing perspective. The market itself tends to be better. So what I showed went back to World War II, looked at all price declines ahead of and possibly incorporating the start of recessions. What I found was that on average, the market tends to peak about 6 months prior to the beginning of recession. So you can see in the middle toward the right-hand side, relative to recessions, S&P 500 decline periods started how many months in advance, and when did the S&P decline end relative to when recessions ended. So with the 6, that indicates that the market tended to peak about 6 months prior to the start of recessions, and that the S&P tended to bottom about 4 months before the recession was over. So I like to say that whenever the NBER tells us that we're in recession, that's probably time to get back in, because it has taken them 7 months to let us know that we're in recession. And as you can see on the right-hand side, there really is no place to hide when it comes to market declines in anticipation of recessions. On average, the S&P was down 28%, NASDAQ down 40%, Russell down 37%, and the MSCI EFA, the Diversified International or Developed International Index, down 34%. But being a Pollyanna at heart, I like to say when life gives me lemons, I try to make whiskey sours. I'm reminded of something that Nobel laureate Paul Samuelson, a professor at MIT, once said, that the stock market has predicted 9 of the last 5 recessions. So sometimes the market gets a little bit ahead of itself. So what do I do is, yes, I look at the market itself because, as I said, prices do tend to lead fundamentals. But I also look at the indicators that the NBER is going to be looking at. These you can find on their website as well. The overall GDP, industrial production, which is the output of all factories, mines, and utilities. Consumer confidence, the Conference Board's Consumer Confidence Index, where if it's 100 or greater shows optimism, if it's less than 100, it shows caution. real disposable personal income. What do people have with which to spend to propel the economy? What's the forecast for retail sales on a quarterly basis? And then lastly, what is our outlook for unemployment? And you can see that, yes, we probably could see a little bit of a slowdown in the third quarter, maybe even the fourth quarter of this year, based on the uncertainty surrounding the tariffs, surrounding what's likely to happen with interest rates, et cetera. But then as we head into the first half of 2026, then we're heading back to a more normal trend GDP growth, an improvement in industrial production, consumers feeling more confident, disposable income on the rise once again, as well as an improvement in retail sales. Unemployment, because of the slowdown in the economy and because unemployment is sort of like a cruise liner, not necessarily a jet ski, and it takes a while to make its turns. We probably could end up seeing the unemployment rate remain at and above the 4.5% for much of 2026. Also, if you remember the chart that I just showed you as to what the concerns have been for earnings, take a look at the pink shaded column, which is what is the most current earnings forecast according to S&P Capital IQ consensus estimates. Now it's at 7.7 versus the 2.2, not surprisingly, because management has always done a very good job of managing expectations. Also, starting the quarter at only a 2.2% rise, I can't help but think that rarely do people injure themselves falling out of a basement window. With the bar set so low, it's pretty much a certainty that we'll end up exceeding that. And as you can see, the 7 declines forecast on June 30th have now become 8 positive moves, and with consumer staples down by only 0.1%, you can really say that only 2 are expected to post declines. That's energy and materials. We've also seen an improvement in full year estimates, 8.3 versus 6.8. And then the estimate for 2026 remains fairly stable at about 13%. Then with the thought is, okay, yeah, we could end up with a bit of softness in the market for the month of August and September. But the softness in Q3 tends to be replaced by optimism in Q4. And that's mainly because investors start looking a good 5 quarters ahead. We certainly don't have the results for the end of that calendar year, so Q4 results won't be released until the beginning of the following year. And investors are now forecasting at least and making their estimates based on 2026 projections. So not surprisingly, the S&P has posted the best return on average in the fourth quarter, up 4.2% in year 1 of a presidential cycle. The frequency of a Q4 advance is 80% since World War II versus a gain of only 65% in the third quarter. So not only a higher average price change, but also an improved batting average or frequency with which the market has risen. So now the question is, well, what should I be doing? What areas should I at least be holding on to, if not adding to? Well, those who have followed me in the past realize that I like to start with history. I think history is a great guide, but it's obviously never gospel. So I start with it, but then overlay our earnings projections, fundamental forecasts, talk to our analysts, etc., to see whether history will repeat or, like the singer of the national anthem, forget the words. So here is a chart going back to 1990 saying, what typically happens 12 months after we have a decline of 10% or more? Well, the 3 sectors that tended to perform the best during the decline, and in this case, it was your usual suspects. It was consumer staples, healthcare, and utilities. Typically, they are up 24% in the 12 months after the market has bottomed, beating the market only 1 in 5 times on average. The S&P itself was up an average of 34%. The 3 worst performing sectors during the market decline turned around and beat the market 75% of the time and posted an average gain of 43%. The 10 worst performing sub industries beat the market 6 of 10 times and posted an average gain of 61%. So basically, you want to hit them where they ain't. And at the bottom of declines, they ain't in those sectors that are likely to show the sharpest recovery because people, in a sense, priced them to go out of business. They did not. And so they represent the greatest opportunity going forward. So which ones were they? Well, the best performing sectors during the recent decline: consumer staples, healthcare, utilities. So from April 8th through last night, these groups were up on average only 8%. Utilities did quite nicely because a lot of them are related to AI power needs, but the majority of them are still your old stodgy multi-utilities. The three worst performing sectors, however: communication services, consumer discretionary, information technology, as a group were up an average of 36%, technology up nearly 50%, communication services up 34%. Really, the drag was consumer discretionary because primarily Tesla. The S&P was up 27%, and the 10 worst performing sub-industries during the decline were up 40%. I shaded the bottom three because they underperformed the market itself, and commodity chemicals down 11%. So independent power producers like Vistra, semiconductors, casinos and gaming, passenger airlines, autos, footwear, and diversified financial services were among the worst performers, but have done quite nicely coming out of that April 8th low. So right now we have overweight recommendations as shown in green for communication services, for financials, and information technology. We have underweight recommendations shown in red for healthcare and materials. Our belief essentially is that this market will continue to work its way higher. Healthcare likely to continue to have some challenges because of tariffs, because of pressure that the administration wants to put on pharmaceutical prices, et cetera. So when we look to the cap-weighted stars, that's our stock appreciation ranking system, combined with what percent of the companies within that universe are ranked 4 and 5, 4 being buy, 5 being strong buy. We also look to momentum, how are they doing on a near and longer term basis, as well as history, and that's how we come up with these overweight, market weight, underweight recommendations. So in summary, as I said, because I'd like to leave some time for questions, second half outlook, I call myself a bull, but with a lowercase b. I think we will work our way higher to 65.80 by the end of 2025. So more upside potential. We did get a complete recovery from the February to early April decline of 19% on June 28th. And historically, the market has gained an additional 7 to 10% after recouping everything it lost in a decline of up to 20%. And through July 28th, we had advanced only 3.5%. So we probably have another 3.5 to possibly 6% to go to the upside. Broadening of returns, we had been seeing sizes, styles, and sectors. That chart that I showed you, what percent of the 155 sub-industries bounced nicely off of the April 8th low and is now improving based on the market's returns yesterday in comparison with what happened last week. Also, what we find is that since 1950, whenever we have had a decline of up to 20%, so from 10% to 20%, in a sense, a deep correction, 5 times we have had a second intra-year decline. The good news is that that decline was less than 10%, meaning it was a pullback, not a correction. Obviously, that's not a guarantee, but it is interesting to think that, well, gee, it's like wringing out a towel. We got out most of the liquid in the first twist. Maybe we have to twist it again, but usually that decline ends up being less than 10%. So if we do end up with a second decline in excess of 5%, we regard it more as a buying opportunity because it probably will not exceed 10%. Also, the typically challenging returns from August through October. While we acknowledge them, we remind investors that Q3 weakness typically gives way to Q4 optimism because we give up on this year and start looking toward next year. And believe me, anything looks good from that far away. Prices lead fundamentals. Yes, we had a pretty sharp downward revision to earnings growth estimates for Q2 and for all of 2025. We have started to see an improvement in that, but I think we still need to see more of that for investors to feel increasingly confident to get back into the market. We think that will happen, so that's why we continue to favor strong performers leading up to the February top, and they being communication services, financials, and technology. So with that, Charlotte, I will turn it back to you and I will open it up to questions.
Well, thank you, Sam. We do have a couple of questions here, and I just want to give a quick shout out to those in our chat who had not heard my earlier announcement. If you have questions for Sam, I realize that the chat box on the left-hand side may not be working for you. Go ahead and click on the image, the little circle on the bottom right corner. You can send your questions directly to me. Now, with that said, I have one here from Mike. He was asking, how much weaker do you think the historically weak months of August and September could be due to tariffs, trade, and economic concerns?
Well, Mike, I think that if we were to be giving up and not experiencing a pullback necessarily, but going down, I think the 6,000 level on the S&P 500, which would be about a 3.5% decline, is something that would not be a surprise whatsoever. That certainly would be well above the average decline that we saw in the month of September. And so I'm sorry, in the month of August. So I would tend to say that 6,000. If, however, we tend to move even lower than that, I think that a Fibonacci retracement level could bring us down about 8.5%, which would be about 5,800 and change, going from memory. So I would tend to say I feel very confident that whatever decline we experience would not exceed 10%.
All right. Thank you, Sam. Next up, I actually have another question here from Mike. He had sent in, we have seen global markets outperform US ones for most of this year. If we do get a Q4 rebound, where does your work show the best profit potential is, here or in foreign markets?
Well, I think that if we start to see an improvement in the U.S. markets, we probably will see investors gravitate toward U.S. areas. The international indices, both developed and emerging markets, have done quite nicely. And from a longer term perspective, they are still trading at a double-digit discount on a relative PE basis. But I think that investors have been taught to buy the dip, and they're probably going to be focusing on those areas that do show the greatest amount of growth here in the US. So I really wouldn't be too surprised if we see a re-rotation back into the US. I think that we should, however, maintain our exposure to the international indices because that rotation took people by surprise earlier in the year. It certainly was a flight to safety, in my opinion, because investors did not want to be moving into bonds or cash necessarily. Also, I guess the question is, what about mid and small caps? Another area that has been trading at a greater than 20% discount over the past 10 years versus the S&P, and a greater than 30% discount relative PE ratio over the past 20 years. Unfortunately, mid and small caps just don't seem to get out of the way. And while investors continue to worry of the potential for recession, that's why they continue to focus on growth. And growth happens to be in the area of technology right now. Just by looking at the earnings expectations, technology expected to show about a 22% earnings gain in the second quarter versus sub 8% for the S&P. Communication services, essentially Meta, Google, up 20% for all of 2025. Tech at 18%, communication services 14.5%, and then looking to 2026, still seeing some good growth in both of those areas. So I think that while we could see investors move back into the U.S. as they have been doing since April 8th, if they see increasing confidence that we are not headed for recession and that maybe last Friday's BLS employment data was an outlier, then I think we could end up moving quite nicely back into the U.S.
Thank you very much, Sam. Now, I have just one more question here for you. This one is from Jeff E. He says, I realize it's a bit early for this, but we are heading into a midterm election year in 2026. Do you have any thoughts on what that could mean for the markets?
Yes, well, good question, because if you look at the chart that's on the screen now, the midterm election years typically have been the most challenging going back to World War II. For the full year, the market was up less than 4% versus 9.1% for all years. The frequency of advance was only 55% versus the more normal 71%. And the two challenging quarters are second quarter and third quarter, meaning as we head into the actual election period of early November in the fourth quarter, investors are nervous. Typically, whether it's a blue wave or a red wave, that wave tends to give up one or both houses of Congress in the midterm election. So that is something that I think investors are looking for to see what will happen this time around. And so, not surprisingly, we had declines in the second quarter, in a sense, leading up to the conventions because of a lot of uncertainty associated with who will be the representatives, usually on a presidential basis, but also on a midterm election basis. Some continued decline from seasonality and continued uncertainties. But the good news is that going back to World War II, from October 31 of the midterm election year until October 31 of the third year, because the election is essentially over, because the uncertainty has been lifted, the market has never declined in that 12-month period. So end of October of year two through end of October of year three, the market was up by double digits in the upper teens on average and posted an advance 100% of the time. Again, not a guarantee, but certainly an encouragement that whatever declines we do see ahead of the midterm elections do tend to get taken advantage of. That vacuum of valuations or of optimism tends to be filled once again and very, very quickly.
Well, Sam, thank you so much. Now, that is all the questions I have right now from our live audience, but I know we still have a few minutes here to go. So while we have some time left, Sam, do you have any final notes you'd like to share with our audience or just interesting bits of information you've come across recently?
Yes, well, I guess something that I just don't know the answer to. There is something called the Somme rule. An economist whose last name is Somme, I forget her first name, showed that anytime we had a 50 basis point uptick in the employment rate from a bottom, that ended up resulting in recession. The real question is, okay, well, when does the recession occur? And why is it that we are not forecasting recession if the Somme rule has been triggered? Well, because things have been very different this time around. Typically, an inverted yield curve led to recession. Typically, an uninversion of the inverted yield curve led to a recession. year-on-year percent declines in leading economic indicators pointed to a recession. Yet none of those has been true because we have not had a recession. Is it because of the of COVID sort of turning seasonality, turning some of these indicators on their ear? Is it because the of all the stimulus that was given out during COVID pretty much needed to be mopped up by the rate increases that we saw in 2022? And also, one thing that I typically like to tell people is be careful what you wish for, because looking at the 7 times since 1990 that the Fed stopped raising interest rates, in the 12-month period between the last rate hike and the first rate cut, that was July of 23 into September of 24. On average, the market was up about 18% in price. Investors anticipating that the Fed will be cutting interest rates. Lower interest rates should be good for the economy and the stock market. Yet the interesting thing is 12 months after the first rate cut, what we find is that the market was up about 4% on average, with three of the 6 prior observations posting declines because the Fed started cutting interest rates ahead of or during recessions and bear markets. So, be careful what you wish for. I find that wishing is a lot more rewarding than having. And this time around, however, through July 28th, the S&P was up about 13.5%, but the 12-month period will be over in September. So we still have a wait and see moment to see what kind of returns we're likely to have. But, when the Fed does cut once again, it could be because they waited too long. And as a result, the economy needs a shot in the arm.